South Africa's bond markets had a rough few months. For a while, there were rock stars of investors. The news broke that the Finance Minister Pravin Gordhan faced the possible arrest by the Hawks, and then it all went a bit pear-shaped. We then saw two money managers halting loans to state-owned enterprises. This is the MoneyMakers. I'm Bruce Whitfield. Tonight I'm joined by Rashaad Tayob, who's a portfolio manager at Abax, to get a sense of where the bond market is and whether or not bonds are yesterday's heroes. Bonds, Rashaad, have been a juicy investment class, especially in low-yielding environments for investors looking for that yield for quite some time.
Yes, you've seen very low interest rates across the globe. A lot of the global bond market is trading at negative yields. So in that type of environment, if you can offer 9%, there's going to be a flood of investors willing to take that risk. So earlier this year, you saw yields in our market yield double digits, while Switzerland and German bond yields were sitting around -1. And that type of gap is always going to attract yield-hungry investors. We've seen quite a rally over the course of the year, but even with yields between 8.5% and 9%, I still think it's very attractive to offshore investors, and that's why you've seen the flood of money that we've seen over the last month, despite all the political noise, issues around Pravin Gordhan and the Hawks. Issues around state-owned enterprises, the money is actually continuing to come into the local market.
It all goes to the whole debate as to risk on and risk off. When risk is off, basically it means that money flows out of perceived to be more stable developed markets and rushes into emerging markets. And we saw post-Brexit vote, for example, that happened in the case of South Africa. Then suddenly, if interest rates look like they might go up in the United States, we see the money flood the other way. It's been massively volatile.
Yeah, I think that risk-on, risk-off paradigm you're speaking of has been the case for the last 3 or 4 years. And that is just a function that we live in a leveraged global economy. So a leveraged system is inherently more volatile than an unleveraged system. So if you look at it from a company perspective, a company with very little debt on their balance sheet, the earnings are relatively more stable. As soon as you load up on debt, the earnings become far more volatile. And I think it's the same philosophy that applies to the global economy. You're in a very leveraged system, and with ultra low rates, there's a potential where you have this chase for yield. But whenever nervousness strikes, because you have so much gearing and so much leverage in the system, when people take fright, when you have nervousness around what the Fed is doing, around Brexit, and then you immediately get the money gets pulled out again, and the sell-off is a lot more aggressive and far more rapid than the rally. And if you're not positioned for that sell-off, you stand to lose a lot of money. We saw that in December. We saw it in December last year with Nenegate. We saw it in these emerging market sell-offs. Third quarter last year, January last year, and the biggest one we saw was the taper tantrum of 2013, where an unexpected move by the Fed caused a dramatic reaction by the bond market. So yes, you can make money in the rally, but you've got to be careful, because when the exit comes, the sell-offs can be quite rapid.
In the equity market, we look at the VIX index to determine volatility. Does the VIX index apply when it comes to the bond market?
There is quite a strong correlation between spreads, so credit spreads on high-yield bonds in the developed market, emerging market spreads, as well as the VIX. So when volatility goes up, you find that these credit spreads widen, and you do get emerging market type of sell-off. So from a bond market perspective, we generally look at spreads as indicators, which is quite correlated to the VIX. And in this type of environment, this type of leverage risk-on, risk-off environment, you find that it all happens at the same time. So if you have too much equity risk and too much credit risk at the same time, there's no diversification benefit, but rather you're losing money on both positions at the same time.
It feels like we're in a more volatile space now than we were perhaps 6 or 7 months ago, are we?
Yeah, I think if you look at what's happening with global markets, you're in a new paradigm in terms of a huge quantity of bonds trading at negative interest rates. So this is something we haven't seen. The bond market has a history of over 500 years, and you haven't seen that before. So the market is busy adjusting to this new paradigm where central banks are looking to continuously ease policy, and everyone's looking for them to be continuously pushing asset prices. And as soon as there's nervousness around central bank easing, how much can they do, is it working? The market loses confidence, and you have these rapid sell-offs. So I think in a way central banks are contributing to this volatility. And then in the local market, the political situation has caused a lot of volatility. So you've got a lot of infighting within the ANC, and then the fights between the ANC and other parties, the DA and the EFF. So all these issues are contributing to a more volatile political, economic, global environment, which inevitably impacts the currency, impacts the bond market.
Now, give me a sense of it, please. The move by Future Growth recently to refuse further extension of loans to 6 state-owned enterprises, 1.8 billion rands worth of loans in the first week of September, last week of August. It was a big move by Future Growth, the biggest bond lender in South Africa. Is it a big deal? Is there the risk of contagion that people were really concerned about in the day or two after Future Growth's move?
I think, I'm not sure about whether there's a significant risk of contagion. Future Growth is probably the biggest fixed income manager in the local bond market. But in the scheme of things, I think there's a huge amount of bond investors, there's a huge amount of foreign investors. So it's not as if one fund manager can, drive some sort of contagion. But we do support Future Growth in terms of what they're trying to achieve, in terms of greater engagement, greater oversight on SOEs, because I think the bond market has been very complacent over the last 3 to 5 years on SOEs. We viewed them, a lot of people in the industry have viewed them as they're 100% state-owned. They consistently get bailouts. When Eskom needs another 20 billion, the government will sell Vodacom, transfer the 20 billion across. When they need more guarantees, when the Land Bank needs more money, when SAA needs a few billion, there's been consistent level of support. And because of that, the market's been very complacent. So I think what Future Growth has done is positive in terms of giving the bond market a wake-up call and saying that, yes, these are state-owned enterprises, but as investors, as stakeholders, we need to have greater engagement and greater say and make sure that the money, these state-owned enterprises are not being mismanaged, and the money that we as bond investors are putting in these companies is being spent in a positive manner. Because eventually, if the companies are mismanaged, if there's too much corruption, it's going to catch up with you. You look at the state of Eskom's finances, for example. Now, Eskom has got huge amounts of guarantees. They've had huge amounts of state support. But if you look at their projects, Medupi is already around 70 billion rand, over budget. It's 5 years overdue. And when you look at that, just that 70 billion rand extra which they need to fund in the bond market, as well as the fact that for 5 years, they're not generating electricity, they're not getting the revenue from that. That puts a significant strain on the finances. And despite Eskom having around 300 billion rands worth of government guarantees, they've used around half. But if you look at their 5-year plan, they're likely to utilize that other half. So you can't have this complacency where you're just saying, I'm not really worried about how that money is being spent, where is it going, because the government's going to provide. I think we're at the situation with a lot of SOEs where you need to be more focused and need to be more, have great engagement to make sure they're being managed well.
And then ultimately the risk comes down to the sovereign as well. And if the sovereign is downgraded, as looks increasingly likely headed towards December, that'll be a downgrade on foreign debt. And if there is a house of cards involved here, at some point, local debt gets a downgrade as well. Once the sovereign faces downgrades, then the SOE sector even less stable from a bond investor perspective.
Yes, definitely. I think that what the rating agencies have said is that they don't necessarily just look at the level of government debt, but they actually incorporate all the state-owned debt in their analysis of the debt to GDP ratio, for example. So we can't be myopic and say, oh, the government debt is below 50% of GDP. Once you add the state-owned enterprises debt, which the rating agencies are doing, it's a lot higher than what the headline number would suggest. And as bond investors, we can't necessarily say we need to be more active in making sure, as guardians of the savings of our investors, we need to make sure we're protecting the capital of our investors, but also as stakeholders in South Africa, we can't say that we're not worried, we're not concerned about how this money is being spent, because if it is mismanaged, it's going to come to us either in the form of downgrades on the bonds that we hold or downgrades on the sovereigns, which affects everyone.
But certainly will. Come December, let's say we do get a downgrade. What happens then to the yields on South African bonds? Because surely investors then will want to be rewarded even more for the perceived risk that they'll be taking on.
Yeah, I think it depends on the global environment at that time, and also importantly, it depends on what type of downgrade we get. So if it's a downgrade which is telegraphed, whereby it looks at the metrics that for us to fit into investment grade from a deficit, from a debt to GDP perspective, we're not fitting into that category and therefore we need a downgrade, but we actually move to a stable outlook, then I think the market can actually absorb that quite well. Maybe we get a slight amount of weakness, but I think that the market can withstand that type of shock. I think the risk is for potentially a bad downgrade, where they look at us and they look at the reforms that were necessary, that were supposed to be implemented over the course of the year, and they take the view that the reforms are not being delivered, in which case you get what I would term a bad downgrade, is where you get downgraded to sub-investment, but then you are put on negative outlook, which means that the market now is looking for potentially further 1 or 2 notch downgrades. And I think in that type of environment, the market is not pricing that risk in. And if you're not getting reform on state-owned enterprises, if there's a potential for the medium-term budget to disappoint, then I think that the risk of what I would call a bad downgrade increases, and the negative impact of that, I think, can be quite significant on the bond market. We're definitely not priced for that scenario.
Rashaad Tayob, thank you very much for joining us this evening. Rashaad Tayob is a portfolio manager at Abax. My thanks to you for watching the Moneymakers this evening, the horror story version, as we look towards December and hope that we can avoid the downgrade if the nonsense around the Finance Minister, the Hawks investigations and the potential of the Finance Minister being charged by the National Prosecuting Authority can be laid to rest, and the Finance Minister can be allowed to get on and do his job as he requested to be allowed to do without any distractions or interference. We could dodge the downgrade in December, says optimistic me, but the market seems to be pricing in other plans. That's it from the Moneymakers for this evening. Thank you for watching. More tomorrow night. Till then, bye-bye.